Wilf, stick around. We want to bring in Greg Branch. He is a partner at 1847 Financial for a look at the banks as well as the bank's impact on the broader markets. Greg, good morning to you. It sounds like you like the banks. You think that they are cheap. Should they be cheap? I mean, we are in the midst of a pandemic. We don't know how the consumer or small, medium-sized businesses are going to come out of this. I mean, there are so many unknowns when it comes to the health of the banks.
Yeah, you're right. And I think that the area of focus, as Will indicated, will rightfully be provisioning, and what the banks anticipate will be losses on loans going forward. That said, the banks traditionally trade at about 1.7 times price to tangible book, and they're currently trading at an average of 1.1 times. So they're one of the few sectors in this bifurcated market that hasn't really participated in any rally. And so even within the group, which is cheap, there are opportunities for those banks that are trading even less than that 1.1 times price to tangible book. And so if you're going to look at this sector, which is, again, overall undervalued, what I'd be looking for are banks that are going to show and participate in areas of strength. And so, as Will indicated, loans are tailoring off, loan books are shrinking, but auto loans has been a source of strength. Mortgages should be a source of strength as the spread between mortgage rates and the 10-year yield increased into the quarter. Trading should be a source of strength, as well as investment banking activity and IPOs. And so I'd look for banks that are well positioned to take advantage of those sources of strength.
Greg mentioned auto loans, and Wilf, I'm curious, from the bank's perspective, the health of the consumer may be a little bit in question, Wilf, because, the consumer has been bolstered by stimulus checks and other help, which could run out at the end of the month if Congress doesn't get its act together. I mean, do we have any indications so far in terms of maybe mid-quarter updates on the health of the consumer in terms of credit card payments, for instance? In other consumer loan payments?
Yeah, we have been seeing some of that credit card data come out as we often do, where the banks will release it kind of via their brokerage investment banking units, and clearly credit card spend in the last couple of updates from some of those large commercial banks has suggested it has pulled back a little bit, particularly in those states. This is the setup, Melissa, where we might see relatively encouraging numbers relative to expectations, followed by commentary a couple of hours later, which says, look, things in the last couple of weeks look much worse. We had hoped that second half provisions would be lower, but based on the last couple of weeks, we can't now promise that. And so we could see some volatility around that. And just in terms of the setup, share price-wise, clearly KBW Bank's index down 35% year to date. It's not like the setup is absolutely impossible. That said, we did jump 5% on Friday. It looks like we're up another 2.5% in the pre-market today. So you've already got 7% of upside in just the last two trading days coming into earnings tomorrow. I'm sure we're going to see some big swings in both directions. And the interesting thing within that will be whether a couple of banks, if they do well relative to the rest, can hold on to gains, or whether the whole sector is just going to keep trading together largely as one in terms of the week that we've got ahead.
Greg, I understand that you like the banks here and you think that they are cheap, but at the same time, do you acknowledge and do you think that money in general is better placed in other sectors like technology? I mean, banks as a percentage of market capitalization has been trending lower for weeks and years now, just less important to the overall markets. And technology, of course, has been picking up that slack.
Right. And so when you look at the performance of growth over the last 12 months to 18 months, you've seen that it has really outperformed to the point where I think we need to start to look at whether the relative valuation or any valuation that we're applying to this is something that we're comfortable with. And so, again, I think we've seen a bifurcated reality where growth, and particularly growth that is well positioned to take advantage of our stay-at-home situation right now, has really outperformed to a significant degree, and some sectors have been left behind. I believe that the banks are one of those sectors that's been left behind, again, trading far less than its historic average. And I believe that within that group, notwithstanding Will's point that we need to keep an eye on credit and we need to keep an eye on what the banks tell us about their provisioning, but they're cheap. They haven't participated. And at some point, the market always reverts to the mean. And I believe that while we can't pinpoint when that will be, the financial system is secure, it's well capitalized, it's liquid. And so some of these names that are trading at less than 1 times price to book, take a name like Huntington Bankshares, which has the highest reserve to loan ratio in the group at 2.1%. They've been very anticipatory. They built reserves after the first quarter, and they'll tell us if they need to continue to do that. As Will indicated, this quarter, we're still going to see significant building, but the important thing will be what they tell us about the back half of the year.
Greg, thanks. Greg Branch, and thanks to our own Wilfred Frost. Andrew.